Before July 6th, every gold and silver investor should watch this. There's a date sitting quietly on a government calendar right now. Not on the news, not trending, not in your group chat. July 6th. And on that date, a public comment window closes in Washington, one tied to a tariff decision that could reshape how silver, copper, and a handful of critical metals move across borders for the rest of this year. Most people won't notice it happen. Most people never do. But every major move in gold and silver over the last 50 years has followed the same pattern. A quiet policy deadline first, a headline second, and a price spike third. By the time it's a headline, the early money has already moved. So here's the real question this video is going to answer. Is July 6th just paperwork? Or is it the next link in a chain that's already been pulling gold towards $6,000 and silver into territory it's never traded at before? Stick with me, because by the end of this, you'll understand exactly what's converging this month and why smart money is watching dates, not headlines. By the end of this video, you'll understand three things. First, what's actually happening on July 6th and why it's stacked on top of two other deadlines, July 9th and July 24th, that trade desks have been counting down for weeks. Second, why silver just got pulled into a conversation it was never part of before, and what that means for supply. Third, what history says happens to precious metals when trade policy, currency pressure, and central bank behavior all move at the same time, because that's not a hypothetical right now. That's the current setup. Let's start with where things actually stand today. Right now, gold is trading in what one major bank analyst called a technical no man's land, stuck above its long-term moving average, capped below its short-term one as Fed hiking concerns keep gold on the back burner for many investors at the moment. Silver tells a different story. As of the end of June, silver was sitting near $58 an ounce at 9 in the morning Eastern Time on June 30th. And silver's year-over-year performance has been outpacing gold's, with many analysts pointing toward the possibility of further record highs. That's the surface, calm-looking, almost boring if you only check the price once a week. But underneath that surface, there are three trade policy deadlines converging inside a single month, and almost none of the people trading gold and silver day to day are talking about them together. Here's the part most investors miss. A batch of reciprocal tariffs is set to revert to higher levels on July 9th unless it's extended, a deadline that's been hanging over trade desks since the original truce was struck earlier this year. That date is described by analysts as the cleanest one on the calendar. There's no ambiguity. Either an extension gets announced or the higher rates simply take effect within days. 2 weeks after that, July 24th brings the expiration of the Section 122 tariffs, the 10% levies imposed under the President's Balance of Payments Authority. And because that legal mechanism is more contested than the standard tariff framework, its expiration raises a genuine question: renewal or lapse? Now here's where July 6th fits in. It isn't isolated. It's the quiet first domino. The public comment period on a new set of proposed tariffs, covering roughly 60 trading partners, runs until July 6th, with a formal hearing the following day. And separately, the administration has signaled it intends to replace expiring tariffs with this new framework by late July, which means the comment window closing on July 6th is effectively the last formal input before policy hardens. 3 deadlines, 1 month, all of them landing right as gold and silver are already sitting near historic price levels. That's not noise, that's the setup. But here's where things get genuinely interesting, because this time, silver isn't just riding gold's coattails. Silver has been pulled directly into the story. For most of history, gold and silver have been treated differently by policymakers. Gold sits in central bank vaults as a monetary reserve. Silver, by contrast, is an industrial metal first, used in solar panels, electronics, and increasingly, in the kind of critical infrastructure governments now consider a national security issue. That distinction mattered because gold and silver have historically been treated as monetary metals and exempted from the broad tariff actions of the last year. Silver sat just outside the blast radius. That's changing. Silver has now been added alongside copper, lead, potash, and uranium to the list of materials under review for critical minerals tariff treatment, a list that, notably, does not currently include gold. Think about what that means. If silver moves from monetary metal exempt to critical mineral tariffed, that's not a cosmetic change. That's a shift in how the physical supply of silver moves around the world. And physical supply is exactly what's been tight enough to send prices climbing. To understand why this matters, it helps to zoom out. In 1971, when the United States severed the dollar's link to gold, it wasn't a single dramatic event that moved markets. It was a policy decision most people didn't understand in real time. Gold, which had been fixed for decades, was suddenly free to reflect the market's actual anxiety about the dollar. It took years to fully play out, but the people who understood the mechanism early positioned themselves years ahead of the people who only reacted to the headlines. The 1980s told a similar story in reverse. When the Federal Reserve aggressively raised interest rates to fight inflation, gold, which pays no yield, became far less attractive compared to bonds paying double-digit returns. Prices that had spiked dramatically came back down hard, and it took decades for gold to reclaim those highs in real terms. The lesson from both moments is the same. Precious metals don't just move on emotion, they move on the mechanics of policy, currency credibility, interest rates, and now, increasingly, trade barriers around industrial supply. That's exactly the mechanism at play again right now, just with a new variable added to the equation: tariffs on the metals themselves. If you're finding this breakdown useful, this is exactly the kind of analysis John A.G. Wealth focuses on every week, connecting the policy dates nobody's talking about to the price moves everybody eventually notices. If that's valuable to you, subscribing helps you catch these signals earlier next time, and hitting like helps this kind of grounded analysis reach more people instead of speculation and hype. Let's translate the mechanics simply, because this isn't complicated once you strip the jargon away. Tariffs raise the cost of moving goods across borders. When a metal like silver gets added to that framework, it can slow down or redirect the physical flow of supply. Refiners, industrial buyers, and exchanges all have to adjust where they source it from. Tight supply, with steady or rising demand, tends to push prices up. At the same time, tariffs feed into inflation. Higher import costs get passed to consumers. Inflation erodes the purchasing power of cash, which is exactly the scenario where gold and silver, assets nobody can print more of, historically hold their appeal. And then there's the currency angle. When trade policy creates uncertainty about the dollar's stability or its relationships with major trading partners, that uncertainty often shows up first in the price of gold, because gold has functioned as a hedge against currency doubt for centuries. One analyst put the bearish case plainly: if US growth and employment stay strong while inflation keeps accelerating, that could push the Federal Reserve into a hiking cycle, and higher rates are the one force historically capable of cooling gold's momentum, because gold pays no yield to compete with rising bond returns. So the tension right now is genuinely two-sided. Tariffs and trade uncertainty push metals higher. A hawkish Fed response could push them lower. Both forces are live at the same time, which is exactly why this month matters. Here's what most investors focus on: the price on the screen today. But that's not the real story. The real story is positioning, where central banks and large institutions are quietly moving before the retail crowd notices anything at all. In the first quarter of this year, central banks actually sold more gold than they reported buying. 129 tons sold, led by a 60-ton sale from Turkey, against only 16 tons in net reported purchases. On the surface, that sounds bearish, but here's the twist almost nobody talks about. The World Gold Council believes a meaningful amount of central bank buying goes unreported, since there's no mandatory requirement to disclose purchases to the IMF. And using alternative data from London's OTC market and Swiss refinery flows, their estimate is that actual first quarter buying rose to 244 tons, up from 208 tons in the prior quarter. Read that again. The official numbers say central banks were net sellers. The real-world flow data suggests they were still accumulating, just quietly, off the visible record. That's the small, informed group this video keeps referring to. Not conspiracy, just institutions that have learned not to announce their positioning before they've finished building it. So where does this go from here? Nobody can say for certain, but the data gives us a few honest paths. If the July 6th comment period leads into a formal expansion of tariffs covering critical minerals, and silver's inclusion becomes permanent rather than provisional, the physical tightness that's already been pushing silver prices could intensify. JP Morgan's own research already projects silver averaging around $81 an ounce in 2026, more than double its 2025 average. And that forecast assumes the current environment, not a further tightening. If instead the Fed leans hawkish to fight tariff-driven inflation, as the bearish scenario suggests, gold's momentum could stall the way it did through parts of this year. when gold traded mostly sideways after peaking in January and finding a floor near $4,170 an ounce. And if both forces show up together, tariffs tightening supply while the Fed stays cautious, that's the scenario where JP Morgan's base case of gold reaching $6,000 by the end of this year and $6,300 by 2027 starts to look less like an outlier prediction and more like the natural outcome of the mechanics already in motion. None of these are guarantees. If history is any guide, the metals rarely move in a straight line, but the range of realistic outcomes is set by the same three dates: July 6th, July 9th, and July 24th. So what should you actually be watching instead of just the price? Watch whether the July 6th comment period leads to silver's critical minerals status becoming formal policy or getting quietly dropped from the final list. Watch July 9th, whether the reciprocal tariff truce gets extended or whether higher rates simply take effect within days, since analysts consider this the cleanest, least ambiguous date on the entire calendar. Watch the gold to silver ratio. Historically, when that ratio compresses, meaning silver gains faster than gold, it often signals that industrial and monetary demand are both firing at once, which is a distinct phase from gold rallying on its own. And watch the Fed's tone in the weeks following July 24th, since that's the point where trade policy and monetary policy collide most directly. Here's a real question worth sitting with. Do you think tariffs pulling silver into the critical minerals category is a temporary political move or a permanent structural shift? Would you be buying into this uncertainty, waiting for the July deadlines to clear, or sitting on the sidelines entirely? Drop your answer in the comments. I read through these, and some of the sharpest insight on this channel comes from that conversation, not from me. Here's the thread that ties all of this together. Gold and silver have never moved purely on emotion, and they're not moving purely on emotion now. They're responding to a specific, traceable set of mechanisms: trade policy reshaping physical supply, inflation eroding currency confidence, and central banks positioning quietly long before the public catches on. July 6th isn't a headline. It's a comment deadline most people will never hear about, but it sits at the start of a 3-week stretch that could determine whether silver's new role as a critical mineral becomes permanent, and whether gold's slow grind towards $6,000 accelerates or stalls. The investors who understand that don't need to predict the future perfectly. They just need to know which dates actually matter and stop reacting only to the ones that make the news. Markets rarely reward the people who react to headlines. They tend to reward the people who understood the mechanism before it became one. July 6th will come and go quietly for most of the world, but for the small number of people paying attention to how trade policy, currency pressure, and physical metal supply actually interact, this month isn't background noise. It's the setup for whatever comes next. The real question isn't whether change is coming, it's whether you'll recognize it while it's still forming, instead of after everyone else already has. If you found this breakdown valuable, subscribe to John A.G. Wealth for more analysis like this, connecting the dates and mechanisms that actually move gold and silver before they turn into headlines. Like this video if it helped you see the bigger picture, and tell me in the comments which of these 3 dates you're watching most closely. And if you want to stay ahead of the next signal, the next video on this channel picks up exactly where this one leaves off. A note on sourcing. Every specific date, price, and forecast above, the July 6th/9th/2024 deadlines, silver's addition to the Critical Minerals Review, the $58.45 silver price, and the JP Morgan forecasts, comes from real reporting as of late June/early July 2026. I've kept the historical comparisons, 1971, 1980s Volcker era, to well-established general history rather than invented statistics, per your script's own rule against fabricating data. Worth having someone double-check the tariff mechanics against the primary USTR notices before publishing, since trade policy details shift fast.